What does the credit risk analysis involve? Which are the factors that are taken into account while performing the credit risk analysis, or which are the key elements of analyzing the credit risk? Let's get the answer to this question. There are broadly 5 factors that you analyze when you are assessing the credit risk of a borrower. I'll list down these 5 factors. This is called the 5 C's model. All these factors start with C. This is a very good model to remember as well as articulate. Each individual bank might divide these into, let's say, 7 factors, 8 factors, 10 factors, but end of the day, if you look at all these 5 factors, they are a very good representation of the different kind of factors that are taken into account in order to assess the credit risk. These 5 factors are character, capital, conditions, capacity, and collateral. Let's understand each of these in detail. Character implies the integrity of the borrower, which means their intention or willingness to run the business properly and pay back your debt. How do you assess the character of the borrower? When it comes to the individual, let's say somebody has approached you for a home loan or a personal loan or a vehicle loan. In that case, you can look at that individual's past track record. Past track record is one of the best things available for you to judge the character of a person. Past track record could indicate you, for example, the person has taken the loan earlier from different banks and has paid them back successfully. You will find that there are no litigations pending against that particular person. He has a very good track record. Let's say he's a salaried person. He has been with the employees for a fairly long time. He's not somebody who's changing the jobs every 1 year or 2 years. He is very well qualified, and therefore the chances of his having a very good earning capacity are better. So all these can indicate you the characteristics or a character of a particular individual. When it comes to business, you also apply the similar test. You look at the management or the owners and look at their character or their track record. Their track record, does it indicate that, for example, they have taken the loan earlier but they have not paid it back, in which case it's a red flag. If there are a lot of litigations outstanding against, let's say, the company's directors, then it is a red flag. If they are all clean, then in that case, the company can be also taken to mean having a good character. Likewise, you can look at the company's financial track record itself. Have the companies been settling the dues on time? How are the group companies performing? How is the holding company performing? Are they paying the workers on time? All those track record you can get into. Likewise, you can look into the board of directors, the independent directors also, what is their track record, what are the other companies on whose boards they are there, and then what is the track record of those companies. So all this will give you a very good idea of the character of the borrower, be it individual or be it business. The second important element of credit risk analysis is capital. How much is the owner's money in business? Because the business can be set up using either own funds or borrowed funds. The businesses where there is a lot of owner's money in business, the owners have a lot of interest in making sure that the business is run well because their own money is at stake. The owner's money is represented by equity and reserves. So if the company has very good equity and reserves overall as a part of their liabilities, let's say the equity and reserves are 60% of the total liabilities. So 40% external and 60% internal funds. In general, it's a good indication that their owners have the skin in the game. They are likely to run the business well, because if there are losses, they will suffer. So owner's capital in business is a good indication of whether it is a good person to lend the money to. The third element of credit risk analysis is conditions. This refers to the terms and conditions that you can realistically impose as a part of the borrowing arrangement. And these conditions have to be legally enforceable. There is no point in putting conditions that are not legally enforceable or which will not lead you to any kind of a result. Typically, if it's a working capital or a cash credit facility against the inventory, the banks put a condition that every month the borrower has to give the stock statements, and the banks conduct the inspection and surprise inspections to make sure that the stock statements furnished are accurate. Therefore, that gives you a very good handle on the business performance of the borrower. any kind of a collateral that the borrower has offered. For example, the stock, or for example the machinery has to be insured. So in that case, you will put the condition that you have to keep all these assets insured, and you have to follow up to make sure that actually the insurance policies are being taken by the business. So these kind of conditions which are reasonable and are enforceable will make your credit more secured. The fourth important element of credit risk analysis is the capacity of the borrower to repay the loan, which means based on their past performance, present performance, as well as the expected future performance, they have very good debt servicing capability. This can be typically gauged by looking at the future performance that is forecasted realistically and looking at ratios like debt service coverage ratios or interest coverage ratio. This will tell you that the borrower has the capacity to repay. Collateral alone is not sufficient if the business is not generating enough profits and cash flows to pay back, and that's why capacity as an element becomes more important. The fifth and important element of credit risk analysis is collateral. Most of the bank lending is against collateral or security. So when the bank gives a loan, they ask for some security. For example, the banks give loan against equity shares, the bank give loan against fixed deposit receipts, the banks give loan against the stock. So all these collaterals, bank has to make sure that they are able to value properly, they are able to note a lien or mortgage on that collateral, and all the adequate documentation is maintained. Also, bank has to make sure that the collateral valuation is tracked from time to time. For example, if the loan is given against equity share, the bank has to track the prices of those equity shares in the market to understand whether the prices are going down substantially, in which case the bank might have to call for additional collateral from the borrower. So collateral makes the bank feel more secure, but of course the other conditions such as character, capacity are also equally important. In fact, character, the first one that I mentioned, is considered as one of the most important factors in assessing the credit risk. If the person or the borrower doesn't have the integrity, stay away from that person. That is what overall the banker's experience says. I hope you have understood these 5 elements of credit risk analysis very well, which is character, capital, conditions, capacity, and collateral. If you have liked this video, please do share with your friends as well as subscribe to my channel. Thank you very much. Cheers.